Hello, everyone, and welcome to Zonda's Playbook webinar for April of 2024. My name is Nicollette Chapman, and today's topic is a great one. I am so pleased to be joined today by Lizy Hoeffer, our Chief Economist, who will kick off the webinar with a state of the housing market. We'll then be joined by our incredible panelists, Lizy Hoeffer, who is the Chief Experience Officer at Cross Country Mortgage, and Travis Rulle, who is the Chief Operating Officer at FBC Mortgage. Now, before we begin, do note that we talk fast and are going to cover a lot of ground. So if you miss anything, don't worry, we'll follow up with a link to the recording. Please submit your questions at any time, and time permitting, we will answer them live. At the end of the event, please do take a moment to fill out our exit survey. Now, who are we? We are Zonda, a housing data firm. We track the entire building life cycle from raw land all the way to closeout of new home communities. Our database tracks actively selling communities across the country, and we can tell you who the best selling builders are and where to find the best-selling communities. Today's event is sponsored by Zonda Mortgage Pro. If you aren't familiar with Zonda Mortgage Pro, this product will help you as lenders secure more builder business by helping you identify opportunities to work with builders who do not have a solid lender relationship. We track market share down to the subdivision level. Simply stated, in addition to helping identify potential builder partners, Mortgage Pro can also help you connect with those decision makers and grow your share of the new build market. To schedule your demo today or learn more about how we can help you grow your builder business, please make sure to request more information at the end of today's webinar. I'd also like to take a moment to invite our customers to our upcoming events. We offer a wide variety of in-person events to connect and network with decision makers in the builder community. Again, for more information on how to access our exclusive events, please make sure to request more information at the end of the webinar. On today's agenda, we're going to kick off the 30-minute session with an incredibly packed housing update. There's certainly no shortage of items to discuss. We'll then bring in our panelists to highlight the NAR settlement and its impact specifically on mortgage lending. And so please allow me to introduce you to our housing guru, Chief Economist Lizy Hoeffer. Lizy did have another engagement today, but wanted to make sure that she was able to share her update, so we've pre-recorded her session. For those of you who have not had a chance to hear Lizy speak before, you are in for a real treat. Lizy has been featured on various platforms, including Bloomberg TV and Yahoo Finance. She currently consults the White House on housing affordability. She is a well-respected thought leader and has a bachelor's degree from the London School of Economics. A bachelor's degree from The Ohio State University. She'd be so upset with me for that. And her master's degree from the London School of Economics. And so with that, let's hear from Lizy.
Hello, everyone, and I am delighted to be here to go through the state of the housing market. Now, where I want to start today's presentation is going back to that interconnectivity between the resale market and new home sales. Now, we like 2019 because it gives us that healthy point of comparison, those pre-pandemic times. But we also want to look at the year-over-year change. Year-over-year becomes important because it flags to us markets that we should pay attention to. Look at Las Vegas, active listings down 40% compared to last year. You can see the markets that have seen the biggest growth: Orlando, Tampa, Denver, San Antonio, Dallas. Put a different way, we're seeing the biggest rise in active listings compared to last year in Texas and in Florida. Now, to us, it begs the question, why are we seeing listings go up? And we think the answer is a combination of some good and bad reasons. If you look at some markets, we know that there's an issue with getting insurance. There's high insurance costs. The renewals are coming in high at the same time that people are getting higher property tax bills. So in some cases, people are reevaluating their living situation. But what we also know is when we ask people, why haven't you moved? Of course, they'll talk about their low interest rate, but people also say, well, I feel stuck. I don't see anything else on the market that I like. We know Texas and Florida are two of our biggest production markets, allowing for a bit more supply, and I think also a bit more mobility. But if you think back to how far off national listings are compared to pre-pandemic, something would really have to change for us to get back to those pre-pandemic times. Which begs the question then, is this good or is it bad for the new home market? Well, we know the bad side of it is that the people that have homes today, many don't have to move. They're okay staying in place. But for those that do, the good is that that lack of resale inventory continues to funnel people into the new home market. As we look at new home sales, you can see March came in above where we were last year, above where we were in 2019. Put simply, we've seen a good start to the year. Not great, not blockbuster, but a pretty healthy market. In fact, we like to take the sales and put a ranking behind it via our Zonda market ranking, our ZMR. This is where we look at sales over time, we look at seasonality, and based on math, we can assign a ranking. Nationally, the market came in as slightly overperforming in February, with 64% of the top markets in that overperforming camp. The green dots are overperforming. You can see there's that cluster, or really that return of the East-West divide, more markets in the Eastern US overperforming. If you think about March's data, we have a new report that's coming out this Friday that will go into the insights. As a bit of a teaser, we also found that March's data came in as slightly overperforming. If you think about this though, it's interesting to see such relative strength in the new home market with the resale market that's still crippled and with higher interest rates and rising interest rates. Remember one of the key advantages, which is builders are offering incentives, mortgage rate buydowns, funds towards closing costs, flex dollars. And those can help address people that are concerned about the market, but also those that are getting really impacted by higher home prices and higher interest rates. The other key advantage from the builder market, though, is what we're seeing with quick move-ins. Consumers are saying, I can't find what I want on the resale side. Many of them are saying, but a quick move-in is basically a brand new home that looks like a resale home. It's already, in some cases, partially built, in some cases, fully built, but someone can move in quickly and someone can lock their rate quickly. But quick move-ins have an interesting history because back in 2022, when the housing market was slowing, we saw this dramatic rise in quick move-ins. And that actually was telling us that at that point of time, builders had more homes than buyers to buy them. Today, we've seen that those quick move-ins have stayed at a higher level, but now it's more of a function of a strategy shift. Just look at Toll Brothers. They said on their earnings call that they used to have about 10% of their inventory that was spec or quick move-in. You can use those words interchangeably. Now they're at 40 to 50%. So builders doing this intentional strategy pivot. And if you track out these quick move-in homes, the change compared to last year, the change compared to 2019, you can see in many markets, these homes are selling out quicker than they can be replaced. Look at Vegas though, #1 on the year-over-year change and #1 on that change from 2019. Remember, Vegas was that one market that has the tightest resale supply. And so we have found that builders have shifted their strategy here to try to fill the gap. What's interesting about today's market though, is that I can tell you that it's slightly overperforming, but the true state of the market depends on the location we're talking about, the sub-market we're talking about, the product, the kind of competition that's out there, who is the builder, who are the buyers. Today's market, it's a lot harder to just describe the state of the market in one or two phrases. Because as we ask builders how the market feels on the ground, we have some builders that are saying, you know what? Consumers are used to these higher interest rates. The market's picking up steam. The market feels really resilient. The majority of builders, I'd say, fall in this middle category, saying, well, the market's stable. It's slow and steady. It's healthy, but it's still rate sensitive. But you'll have your fair share of builders saying the market is crazy unpredictable. They're fighting for sales. They have to do heavily discounted inventory. Put a different way, I think the way that I can describe the market comfortably today is that it takes a lot of work. It takes a lot of marketing effort. It takes a lot of money and a lot of cases using those incentives to secure a sale today. But if you step back, we know that the new home market has been this dominant player because of the incentives and because of inventory. Builders represent 30% of all of the inventory today, up from 10 to 15% historically. We wanted to run the math. We wanted to say, what if, all else equal, existing home inventory goes up by 10% from where we are today, 30%, 50%. It's at that 50% rise that we're still above that historical level of new home inventory. So we see new home continuing to be this dominant player. As we look at housing starts, as we think about where the market goes from here, even with interest rates going back up, we still capture 80% of builders that anticipate starting more homes this year versus last year. Our forecast at Zonda is calling for 4% growth. So builders controlling what they can control to help bring more inventory to the market. Now with that, I'd like to kick it back to Nicollette for the main event, how the NAR settlement will impact mortgage lending. Thank you.
Thank you so much. Now that we have heard from Ali, I'd like to begin by introducing our esteemed panelists. Today, we will be joined first by Lizy Hoeffer, who is the Chief Experience Officer at Cross Country Mortgage. She began in the mortgage industry as a receptionist, but has worked hard to become a top loan officer. In fact, she has been named a top women originator multiple times by Scotsman's Guide, including ranking as the #1 female loan officer in the nation. That's an incredible accomplishment. On top of that, she was also ranked the #1 Latino mortgage originator in America in 2021 by the National Association of Hispanic Real Estate Professionals. Lizy's not only an outstanding originator, but she is also completely dedicated to her clients, to her community. She has 3 beautiful children, and really prides herself on balancing a challenging career with a caring outlook. So Lizy, thank you so much for joining us today.
Yep, happy to be here. Can't figure out lighting.
You look great. I'd also like to introduce you to Travis Rulle. Travis is the Chief Operating Officer of FBC Mortgage and is responsible for streamlining and managing the loan origination process. Travis has over 24 years of industry experience and is a forward-thinking operational designer that connects dots between the loan operating systems and the state-of-the-art technology such as robotic process automation, machine learning, application programming interface, and optical character recognition, things that are much over my scope of work. So good that other people like you are able to do those things, Travis. Prior to joining Team FBC in March of 2021, Travis built and designed and led large origination operations and departments at both Round Point Mortgage Servicing and Freedom Mortgage Company. He lives in Charlotte, North Carolina, and earned his BS in Business Administration and Finance from Liberty University in Lynchburg, Virginia. So welcome to you as well, Travis.
Great to have you. Great. Thank you for being here. Or thank you for having me join you. Sorry.
Absolutely. So let's go ahead and get started. You know, Ali just gave us some pertinent economic data, all of which, of course, is extremely relevant. It's just another reminder that the thing we can always rely on in our industry is change, which brings me to really the purpose of our panel today. Perhaps the biggest disruptor in our industry has really been the NAR settlement. I'd like to start by asking each of you, how big of an impact will this have, not just on the real estate industry, but specifically on mortgage lending? And Lizy, why don't we go ahead and start with you?
Yeah, I think this is an interesting question, primarily because the NAR settlement hasn't been accepted yet. And I know that there were all those recent releases from the agencies that talk about how if the custom is that the seller pay for commissions, that it's not included in the IPCs. But all they're saying is that for now it's status quo until there's a final decision, which doesn't really happen yet. And even in this case, it wasn't taking place until July. So I don't think we totally have a full concept of how it'll change. But I do think that just for people that work with first-time home buyers, people that are challenged with that initial cash outlay. I think we're going to start seeing programs like the Smart Start or Community Promises, like those are programs that are specific to cross country that will help, bridge the gap for some of those buyers. I do think that unfortunately, with the way the economy is headed, it's an economy of people that have and people that have not. And that separation between, wealth is growing larger. And so I'll be interested to see how this directly impacts, because you have a lot of home buyers. Like, for instance, I'm surprised that VA hasn't come out and said anything about veteran buyers. FHA is like, thank God we have 6% that can go towards it. I mean, I think there are going to be a lot of solutions for first-time home buyers, but right now I don't think we have enough answers.
Fair enough. Travis, what are your thoughts?
I think to add to her points, I think to answer the question, let's assume everything goes forward in July. And, for those of you not familiar with, specific elements of the NAR ruling, the one that I think is the most important is the prohibition against marketing seller paid commissions within MLS. And so sellers can still pay buyer commissions, but it's a lever, I think now for sellers versus it was kind of just the standard practice. But to really answer what I think might happen, we have to look at our buyers. And so we did a data study, our FBC data center, we did a data study of 15,000 customers over the last 12 months. And this is all buyers, specific to builders. So the builders on the call, we studied just the 15,000 builder customers that we touched in the last 12 months. 43.7% of every buyer required some concession from the builder or the seller to qualify for the loan, whether that's they didn't have income or assets or couldn't pay the closing costs. So if you were to stack on top of that the buyer commissions, half of your buyer pool would no longer qualify, assuming rates stay somewhere in the ballpark where they're at today. To take that even further, 10%, so 1 out of 10 customers had insufficient income and assets, while 18% just had insufficient income, and 13%, which I think is the most specific group to this nuance within this ruling, 13.9% just didn't have the assets to pay down payment, closing costs, a rate buy down, which is customary in this market, and then on top of that, buyer commission. So I think if it goes forward in July, I think that the seller, whether it's reseller, builder, is going to continue to use that lever to attract the widest net of potential buyers, both on the builder and resale market.
Those are some pretty incredible stats for sure. I think, we all know how much affordability is a crisis right now in terms of just the overall part of being able to buy a house. But I have a question that came in on the chat, so I'll ask you for it. What do we think that Fannie and Freddie or Ginny will make changes to the IPC rule to actually just allow for more IPC in general?
Lizy, I'll let you go. I don't step out of turn here.
Oh, it's okay. I do think that they're going to make changes to lending personally, because that's in their best interest. Like, they don't want to lose 43% of the buying pool. Not to mention programs like FHA were specifically created to allow for affordability. I think FHA, one thing that I didn't say before is I do think FHA will become a more predominant loan product should Fannie Mae and Freddie Mac not follow suit with the 6%. But I do think that they will make some allowances, or there'll be additional programs that are created to bridge the gap.
Interesting. Well, that brings me to my next question, right? So, because buyers will now be responsible for paying that selling agent's compensation, it's understandable that this would affect affordability substantially. After all, it is hard enough, like you said, Lizy, to sort of save up for that down payment and or closing costs, which would in fact make FHA more relevant. Fannie obviously just came out and said that the seller can pay that buyer agent compensation without it going towards that max seller contribution, which I guess, like I said, is somewhat of a win. But there are areas that haven't necessarily been touched on yet, like a VA loan. Tell me a little bit, and if you wouldn't mind, get into the sort of the nuts and bolts for people who don't understand what the max seller contribution is, what a veteran can pay for, and what they can't pay for as part of a VA loan, just to educate our overall audience.
Well, just so people understand, so there's limits to the amount of closing costs a seller is able to compensate a buyer on a transaction, and things that are not customary, so like big incentives for repair costs or improvement costs, like things of that are like disallowed. So depending on the loan program, you get 6% max seller contributions on an FHA loan. VA loans are 4%, but then you can add things on like, you know, like discount points. So it depends on how that deal's negotiated. And then you have different, like a scale for down payment requirements on a conventional loan. So like 3 to 10% is a 3% contribution. Once you get to 20%, it's 6, and then 25%, it's 9. And so you have a lot of flexibility in terms of what you can ask for when you get a lot of seller contributions. One thing I do want to be clear on with that Fannie Mae ruling, it's being, I think, misinterpreted. What they're saying is that if it's customary for the transaction, it will not be included. But let's say you have a transaction where the seller is not paying for a buyer agent representation and there is a buyer broker agreement. My understanding is that it would still come out of the seller contributions in that case, and which case you would be limited. So like, I think that there's some ambiguity with that statement, as it said, you know? And so I think every state has different laws for how they handle commissions. I think that they are not the only people that are at play here, and it's up for interpretation. So just careful with that. And then as far as VA is concerned, they have disallowed agent compensation as part of a fee that veterans can pay for. So this entire concept would mean that they can only purchase houses from people that are willing to pay for their buyer agents.
It's such an important piece not to be overlooked, I think, for sure. Travis, I'd love to hear your additional thoughts on that.
Yeah, I think Lizy nailed it. To further kind of the point I was making on just the general population of buyers, you think about just for lack of better terms, maybe we'll call it an entry-level home buyer, first-time home buyer, entry-level home buyer, for builders on this call or loan officers that work with builders that are in that entry level. The same stats that I gave on the broader level included all different home types. That same data study where we looked at just entry-level home buyers, the net effect, and this is how tough deals are right now in the current interest rate environment, 69% of entry-level home buyers required seller concessions to close. So 7 out of 10 people, whether that's insufficient income or assets, that was 26%. Insufficient income alone was 26%, roughly similar to the all-in, and then insufficient assets, 15%. So this really does impact a new home, or first-time home buyer or entry-level home buyer quite a bit, a lot more than obviously the move up or the custom home consumer out there. So I think the things, everything Lizy said was spot on, but this I think really impacts that consumer, and therefore I think the normalization or the customary approach of seller covering buyer commissions is going to continue for some time. Now, while we're talking ICPs, I think that there's one thing that as lenders and builders or whoever the sellers on this call need to be cognizant of. The ruling says that a seller can market that they pay closing costs, and where I think we got to be careful not to get into another topic is the itemization of those closing costs in a contract, so then we could appropriately assign it within our disclosure package. I think that will be interesting to see how that unfolds. And I think it'd be prudent before, I think a trend appears to get ahead of it. And for anybody on this call that does these contracts, in your contract, enhance your boilerplate itemization of your concessions, especially the builders, to include that itemization. So it'll be interesting to see how it unfolds with the contribution perspective.
Absolutely. And I think just as we're even having these discussions on this panel today, I think it has opened my eyes even about how much more really is to unfold. I mean, it's not just as easy as about talking about IPCs, but really also how do we internalize that? What does that actually look like in terms of writing it into a contract and making it make sense? So really interesting. And I know on this next question, we talked a little bit about how this is going to affect VA, right? But I'm curious as to hear what conversations you're having on the streets. Like, do people feel like it's going to be business as usual, or is there panic in the streets? What are you hearing from pre-qualified first-time home buyers about their thoughts?
Surprisingly, I think consumers do not hear this news as much as we do as lenders and real estate professionals. I actually anecdotally have not had one client mention anything about it. And I think it's because the change really hasn't come into effect. And I think as an industry, real estate agents are still pro marketing, and paying buyer agent representation. I mean, there's a lot of reasons for that. One, it limits liabilities for the sellers. It actually isn't more affordable for a seller. Like if you're thinking about the buying cycle, they pay 3% on a house that they're selling. That's typically a lower price than the house they're buying. So if they were going to forgo that once, they just end up paying a higher percentage on the buy side of their house. So it's interesting because consumers, at least in my opinion, just aren't aware. They're not asking the questions.
Interesting. Are you hearing the same thing, Travis?
Yeah, I completely agree with her. I think where the conversations are being held is on the brokerage side, with the potential of maybe a revenue collapse on a transaction, and some realtors obviously feeling that heat. But I still think that the jury's out. We got to find out what happens before July, and I think then that's when it will start to become real. And I think you'll see, if any change does happen following the ruling, I think you'll see a very slow turn of the rudder. And I do think it will be strictly correlated with the interest rate environment as well. So if you see a market become bullish again, rates drop, I think that will put fuel on a fire to see to expedite the shift and how this will change the landscape of a transaction. But if rates stay high, I think the seller, it'd be prudent for the seller to continue to use that lever to make, to attract the widest net possible to all their potential buyers.
Sure, definitely. And as we're sort of coming up to the end of our webinar, I kind of want to wrap it up with this. And for those of you who are familiar with Zonda, and if you've heard me speak before, I am a huge believer in originators having builder business as part of a diversified portfolio. As if it weren't enough that in some markets like Austin, over 40% of purchase closings last year were new construction. It's my belief that the NAR settlement is actually just another win for builders. Why? Well, builders are very savvy sellers. They're expert marketers. They're able to reach the consumer directly and aren't nearly as reliant on traditional selling agents to be able to bring buyers, right? So if I were to give a single piece of advice to an originator, it would be to really dive into new construction in order to figure out how to be a good partner to get to builders and get a piece of that pie. So I'm going to ask you guys, what would be the single piece of advice that you would give to a lender looking to find success in this environment?
That question's for us, right, Nicollette? Sorry.
Pardon?
Yeah, I would say if I was giving advice to a lender, I would say getting back to the basics of the hand-to-hand handshakes, getting out in the field, making the calls. But I also think too, as a lender, you've got to look forward. We're on the fringe of incredible change within our industry as well. And we're at that crossroads where I think in the next few years, we're going to have to originate faster, cheaper, whether we like it or not, and be able to do things slightly different than we're doing today. And if you're not thinking about that right now as a lender and how you're going to be able to serve builders and realtors in the next few years, I think you're at a disadvantage. And so, I think a lender's got to look forward. It's got to use the data way differently than they would normally use data to make a credit decision, like we're doing at FBC on home price sales and suggestion analysis for home builders, et cetera. It's a changing landscape, and it's changing fast. And as an industry, we have to be prepared for that. And so while NAR is a big change in the real estate space, I think as lenders, we're on the cusp as well too. So, and mostly due to technology curve and the speed in which it's advancing.
Great advice. Thanks, Travis. And I'll leave it with you, Lizy.
So as a loan officer, you have to remember, if you worked back in the days of Dodd-Frank, that when our commissions changed, we really had to learn to differentiate ourselves. And this is something that you can teach your real estate partners. So they, especially buyer's agents, they haven't been prepared for what it is to have a buyer presentation, how to articulate or quantify really their value. And a lot of people market themselves on their great customer service or their communication. And then those things are really, really challenging when you're talking about your monetary impact and value. And so you really have to teach your agents how to market how much they save somebody in a negotiation, how much closing costs they're, getting for their buyers, and really help them with their unique selling propositions. It's a great opportunity for you to become the sales coach and really help your agent partners separate themselves from all the other people who are panicking and not adapting to the change. Anybody who's just getting into lending and just getting into real estate right now is going to clean up because they don't have, the mountain to climb that all of us have to do in terms of adaptation. But I really do think that if you can become that person that teaches them how to market this and how to create solutions, you will have a ton of business.
Absolutely. It's always about providing value. And I couldn't agree with you more there. Well, listen, I know that we do have quite a few comments and questions in the chat. We are up at our hour, but I will make sure that those questions all are answered via email. We will distribute those questions as well to our panelists. So please know that we do see those questions and we will make sure that they are answered. In the meantime, I do want to remind you that if you are looking to do builder business, there are over 22,000 builders across the country that are still doing deals and that need lenders. So please do the research, make yourself available. And I want to thank you for joining us today. The recording will be posted on our website within 24 hours. We will also send you the link automatically as just being a registered attendee today. And of course, please follow us on social media, reach out to us if there's anything that we can do to help you. We are all in this together. So thank you for joining us. Lizy, Travis, thank you. And we look forward to continuing partnerships.
Thank you.
Yeah, thank you.